It was a really interesting piece, Carl, because he laid out very specific reasons as to why the Fed needed that bigger balance sheet for longer. Can you walk us through some of them?
Right. So basically, the balance sheet should correspond to liquidity in the banking sector as well as the size of the macroeconomy. So we are bigger on both accounts compared to where we were when QE was initially introduced. And so that means that as we normalize the balance sheet, it doesn't have to be a full reverse, but to some higher level, likely over 1 trillion.
We haven't really heard that from any Fed officials either. It really just seems to be about when they're going to do it and how to do it. Are we going to start to hear that conversation percolate?
They've been quiet on that front because there is so much disagreement on the timing and pace of the unwind and whatnot. So, again, this is in the nuanced details, which they're working on, but not trying to make a strong case publicly. I suspect they're working behind the scenes to figure out how this will all work out. And mind you, most importantly, the Fed has to have the buffer in case they make a mistake, right? We saw the taper tantrum and how that panned out for the housing sector in particular. Policymakers want to have the Fed funds rate high enough that they have a buffer to reverse course if things do not go smoothly.
The timing of this is intriguing. They're talking about a conversation maybe for next year. If you've got a Bloomberg, and if you haven't, I'm going to bring it to you right now. Debt goes the function. You can bring this up and you'll be confronted with this page. It's all the holdings of treasuries. Go to the far right tab and have a look at Fed holdings and look at when these start to roll off. Look at that hump right there at 2018 on the far right side. Over $400 billion of treasuries are set to roll off the balance sheet in 2018. The policy is to reinvest. The conversation is around maybe stopping doing that. It's intriguing that they're talking about it now ahead of a massive hump in 18, 19 and 20 and beyond.
Right. And so as they're looking at the dynamics of the balance sheet, they're saying, well, maybe we can't just pull the plug and say no more reinvestment because that would be very unsteady. Instead, they have to figure out some sort of formulaic approach to making sure that that deflation of the balance sheet occurs in a very smooth and orderly fashion.
You know what also is 2018? When Janet Yellen will no longer be the head of the Fed. So there also is this time urgency since we don't know who's going to be replacing her, David.
Exactly, but when you brought this piece actually to my attention, and the thing that struck me is he's really adamant. Whatever you do, you should make it clear right now, you're not going to reduce your balance sheet until after you get your interest rates up. It's a sequence. Whatever the size of the balance sheet should or should not be, don't even touch it until you get the interest rates up.
Absolutely. So at the time when quantitative easing was being introduced, which was in the depths of the financial crisis, Chair Bernanke tried to convey with great confidence to the markets that don't worry, this is not really a separate monetary policy tool. It's just more easing, even though we're closing in on zero for the Fed funds rate. This is just pushing the lever further. And then when we view the transcripts of those meetings and hear what was happening behind the scenes, there was far less confidence. Well, throwing the engine into reverse doesn't mean just changing the sign, right? There are also unintended consequences. So the Fed has to move very slowly and very cautiously because we're still growing at a fairly slow pace.
Well, Carl, Fed Chair Bernanke ran a very different Federal Reserve. When he had his semi-annual testimony and he approached Congress and said to them, you need to do more, you need to do more, little did he think that several years later he might get an administration that might actually turn around and say, you know what, we might do more. And isn't that the real story here, that you've now got a Fed Chair, Janet Yellen, that has done the same thing as former Fed Chair Ben Bernanke, which is you need to do more, you need to do more. Now they're thinking about doing more, and that maybe rate policy isn't the only tool in the box that they can use or should use, given that fiscal stimulus could be coming.
Right, so timing is everything, and the timing of fiscal stimulus is certainly inopportune in this economic cycle. Nonetheless, it does look like it's coming down the pike. I don't think it's a big 2017 story. I think it will be more concentrated into future years. But if the fiscal lever is pushing in a positive direction on the economy, then that does ease the burden on the Fed and allow them to move a little bit more quickly with either normalizing interest rates or normalizing the balance sheet.
And the question for me then is, if that starts to happen with the balance sheet, 2018 maybe as we get more fiscal stimulus, are we going to see the private demand to support the roll-off?
Well, that's the question. I mean, given where interest rates are right now, you would say that the demand is really there, right? Interest rates, even though they have backed up since the election, are still at extremely low levels. So the Fed has to just move very cautiously, right? Look at issuance under Trumponomics, what new debt issuance could look like, and then kind of smooth this out so that we don't have a clumsy exit as more supply comes onto the market.
While we change Fed chairs, you know, no big deal.
Maybe change Fed chairs. Maybe.
Right.
Janet, if you're listening, please consider an additional term.